Welcome to the Multifamily Investor Nation show. I'm your host, Whitney Elkins Hutton, Director of Investor Education here at PassiveInvesting.com. And I'm excited that you joined us today. Today, we have a very special guest, Michael Zaransky. Michael, welcome to the show.
Thank you for having me. It's a pleasure to be here, Whitney.
Yes, yes. Well, before we dive into the details of your property, Jack's 166 units in Chicago, Illinois, tell us a little bit about yourself, specifically your background of how you got into the multifamily space and where you're at today.
Sure, I've always loved real estate. I grew up in a family that owned apartments throughout the Chicago metropolitan area. And although I went to law school, I never practiced law. And upon graduation from law school, I intended to go into the business. And I did all kinds of first local Chicago area apartment development and condo conversions, stuck to multifamily only, and then branched out to build a student housing portfolio on 9 campuses throughout the United States, which I successfully exited, as well as have investments currently now in multifamily communities in 3 states. Most recently, our purchase here in Chicago, as you mentioned, but we're also active in the Texas markets as well as in Tennessee.
Awesome. Well, let's dive in, Jack's 166 units in Chicago, Illinois. When did you close on the property and what was the purchase price?
So this is a very fresh deal. We just closed on August 15th. We're recording now on August 27th, so just 12 days ago. It's a deal that we actually pursued for 1 year. Unfortunately, although I'd be happy to share as much as I can about the deal, the contract that I signed with the institutional seller prevents me from disclosing the exact purchase price. But I could tell you that it was a 2020s built high-rise building that the brokerage firm, the national brokerage firm, was offering and suggesting at a price of somewhere around $50 million.
All right, so 166. So you guys can kind of back into the per unit purchase price. If it was being offered at $50 million, 166 units, we can do some simple math there to find out the per unit price. You said you've been
Right.
chasing this deal for the better part of a year. When did you first look at this property and how did you find it?
So we were approached by one of the national brokerage firms, Neimark, their Chicago multifamily office, who was engaged by the institutional owner of this property, who had built and developed the property ground up, brought it online in 2020, had a construction loan that was extended a couple times that they wanted to get out of. So we looked at the property approximately a year ago from today, initially, um, gave them an informal offer. At that time, they actually chose another buyer for the property who went under contract and didn't have the ability to close, ended up defaulting on the contract. So they came back to us just last spring. There were multiple bidders. There were 3 or 4 bidders on the property. They pre-qualified and identified bidders that they thought could close on it. And we emerged as a successful bidder. We knew we really wanted this property. It's in a submarket called the West Loop of Chicago, which is a very hot, growing area. It's where Google has their Midwest headquarters. McDonald's recently moved their world headquarters to this neighborhood. And it's an area that's very vibrant with entertainment and restaurants. And it's an area west of the Chicago Loop that has become a mecca for young people wanting to live and work in. So we were very excited about the opportunity, and we put our best foot forward on the bidding process until we locked it up and emerged as the successful bidder. We went under contract approximately a little over 60 days ago and closed within 60 days on the transaction.
So what I want to kind of point out here is even though you saw the property a year ago, that's whenever you first found out about it, you stayed in
Yeah.
contact, it sounded like with the sellers group and, with the previous buyer defaulting on the contract, it came back to you, and you know, you can get a deal done if you stay in connection with people. Were
Yes.
there other groups that were in competition, with you before you getting it under contract 60 days ago?
There were other groups. There was actually several groups. I think there were 8 offers on the property. The seller, with the assistance of their brokerage firm, narrowed the field to 3 finalists and invited 3 finalists, us included, to make a best and final offer. We raised our purchase price, and we also raised our earnest money deposit, and submitted our revised offer. And the seller actually conducted buyer interviews, which we did on conference call with a committee at the seller. And they had a buyer questionnaire based on, wanting to know about our track record, our ability to close, our financing, our equity. And we were selected out of the final 3. Combination of putting our best foot forward on a very, very strong offer, as well as impeccable references on our track record, including letters from our financial institution that confirmed that we had the funds available to close the transaction.
Mhm. Well, let's talk about the actual getting it under contract. When did you actually set foot and walk all the units of the property? Was it before getting it and locked up under PSA, or was it after the signed purchase sale agreement?
We walked many of the units before the PSA and before the offer. We toured the building twice over the last year and got a representative sample of seeing the unit layouts, combination of the model, the vacant units, as well as the common area space, which is pretty extensive in this building. And monitored at the same time the rent roll, which was readily made available anytime we requested it, as well as the operating statements, the ongoing income and expense statements, so we could see the progress of the building. Unlike some other markets, what we noticed, and the reason we were attracted to this particular submarket into purchasing rather than developing ground up, is that rent was actually growing and continues to grow in this particular submarket in Chicago. Over the first 6 months of this last year, we noticed the trend of an approximate 7% rent increase, combined renewals and new leases, which is exceptional, as most of your listeners know, in this particular market.
Awesome. So was your earnest money hard in this case? Like, how much was hard upon signing, and do you have additional money go hard throughout the process?
What we did here is we felt comfortable enough with the number of times we toured the property. One of the times we toured the property with our in-house engineering and maintenance staff to check on the quality of the construction. We knew the builder, the general contractor, who has an impeccable record. And we decided to stand out on with the crowd. And in our buyer interview, we offered to go hard on our earnest money the day we signed the purchase and sale agreement, which is a throwback to maybe 5 years ago when there was much more competition in trading for deals. And I think that really made us stand out.
Well, let's talk about, now that you got the property under contract, let's talk about the due diligence part. Let's start with the physical due diligence. How did that go in the building?
It went exceptionally well because it was a newly constructed building, and part of the due diligence material that was available to us was all of the building plans and specifications, as well as the architect's inspections and sign-offs on all the draws, as well as the permits and inspectors' sign-offs from the city of Chicago. But nevertheless, we brought in a professional engineering firm to do a full property condition report. We found a couple minor minor issues, nothing major or structural, but some minor maintenance issues, which we actually pointed out during due diligence to the seller. Frankly, we were wondering what their reaction would be since our earnest money was already hard. But fortunately for us, they recognized these as routine maintenance, and they took care of the open items prior to closing.
Mm. How did the financial due diligence on the property go?
It went very well. What's nice about properties like these that are institutionally owned and larger deals is they're also professionally managed by a third-party manager that's very well recognized. It's a regional firm. We know them actually and have a relationship. You mentioned before the importance of relationships with this particular management company and trusted them. But as a result of their professional management and the transparency they had with their institutional client, we were able to get great cooperation under the due diligence clause in getting rent rolls and doing a deeper dive into the income and expense statements, in getting backup for certain expense categories that we wanted to look at, as well as rent collections. And the books and records were readily available to us and very easy to finish our due diligence.
Now, it sounds like the physical and financial due diligence went pretty well in this, new build apartment building. Were there
Yes.
any other surprises that we haven't touched on?
Um, there really wasn't a major surprise. It was kind of routine stuff. During the contract period before closing, we noticed there were ups and downs on occupancy just for expiring leases that hadn't been renewed and were available and perhaps not rented as quickly as we would like had we had run the building. But it was really a minor hiccup. Eventually they got rented. We ended up taking over a building that was 96% occupied, with virtually zero delinquency. There's one problem tenant out of the 166, but that's being worked out. Just a remarkably well-run building. There were a number of contracts that we had to spend time going through to decide whether or not we wanted to keep them, various service contracts. For HVAC, for example, the trash contract, an electrical provider contract. That took some time. We ended up accepting and taking all the contracts, but no real major hiccups in the deal. In fact, we were so pleased that we actually got it and were awarded the deal because we're buying it at so far below replacement cost. If there wasn't, it would have to have been a major item for us to get spooked and not move forward with the deal.
Well, let's talk about the financing for the deal because that's been a challenge in the past 2 to 3 years. What kind of lending
Yes,
did you use on this particular project?
we actually had a variety of choices. We had two different sources available to us. One was agency financing through Freddie Mac, where we have a very long-term and very positive relationship. We could have locked in with them for a 5-year period of time at a pretty attractive rate. However, in the end, we decided to go with bank financing, a relatively low leverage loan, about 60% financing. We did a 3-year deal, interest only, fixed for 3 years. And in this particular deal, in the current interest rate environment, we thought that was a better option for us because we believe, and it's been confirmed post-closing, that interest rates will probably go down sometime over the next several years, where we intend to refinance. At the same time, we put in a business plan to increase net operating income, both through increasing rental rates and controlling some of the expenses. And as a result, we think in a year and a half or two, we'll have a substantially increased net operating income in a low interest rate environment where we intend to do a refinancing, most likely with Freddie Mac, and likely have cash out proceeds available to us to distribute out.
So in this particular bank financing, 3 years interest only, are there any payment penalties, lockout periods, any extensions?
Right. We purchased, in order to get the fixed rate, we purchased a swap through the bank, and that needs to, if we, there's no lockout period, but the loan itself has no prepayment penalty. However, we have to pay to break the swap, so that as interest rates go down, there'll be an amount that we'll have to come up with, but we don't think it'll be tremendous. It'll be a relatively low penalty to unwind the swap and pay it off.
Hmm. All right. Now, how much, and you said you did a 60% loan to value, right? So if the
Yes.
purchase price was somewhere, the assumption around $50 million, 60% of that was bank financing. How did you come up with the rest of the money, the equity in the deal?
We use our own internal family funds for the bulk of the equity in our deals. However, over a number of years of successful investing and transactions, we've built up a pretty substantial following of investors that participate with us in deals, and we raise capital for all our deals, not through a fund, but one at a time, one deal at a time, as one-off transactions. We feel that's better, puts less pressure on us to have to put out money. And we raised the equity between our own funds and long-term investor interest within 10 days. So we have we're in the nice position of having a cadre of investors as well as our internal funds that give us the ability to close on transactions like this. And we actually had more equity available to us than we needed. We turned down some investors or cut some allocations back. We'd rather be strategic and find the right deal to purchase or to develop than just to keep buying stuff because we have the equity available.
Mhm. So how did you structure this deal for your investors? And, particularly I'm interested in like any preferred returns, splits, IRR hurdles, tranches, and fees.
Sure. We kind of have a standard that we've developed over the years that our investors have come to appreciate and that we think is fair, is we pay our investors a 7% preferred return, which gets paid ahead of any other money. The actual cash equity we put in is treated the same as a member investor. It's 7% preferred return on that money, and of course pro rata. And after that, we return all capital to investors. And then once all capital is returned, we have a 70-30 split, with 70% going to the investors and 30% of the excess coming to us as a carried interest. We don't have hurdles or tranches on IRR. After we've returned capital, we just do a straight 70-30 split on all excess.
Awesome. So what kind of fees are you charging to the deal?
We charge a 1.5% acquisition fee. And then we, of course, earn the 30% carried interest, assuming the deal's successful and there's excess capital to distribute.
Mhm. Any asset management fees, disposition fees, refinance fees?
We charge 1.5% asset management fee throughout the life of the deal on the amount of the equity that's raised in the deal. And there's a 2% disposition fee.
Gotcha. Now, this is a new build building, and you talked about after somewhere within the 3-year timeline, in anticipation of interest rates falling, that you're going to do a refinance. What is your overarching business plan with this building? Are you looking to exit in 5 to 7 years? Are you looking to hold in perpetuity? Like, what does this exit look like for you and your investors?
Yeah, we plan. I mean, we like to have some flexibility, but we projected and planned a 5-year holding period. We think the return over 5 years will be a 2x or 2 times capital for an investor. If an investor, for example, puts in $250,000, they should get back $500,000 in total over the life of the deal. Most of it tax sheltered through depreciation and the balance at the capital gains rate upon disposition. But if the property is as successful as we think it might be in a really best case environment where rents continue to escalate, values bounce back in the market, and cap rates return to where they were, it might be possible to do another refinancing of this property and return all the capital to investors and still own it and continue to have distributions. If that could happen, we'll consider at that time holding the building a little bit longer. But for now, we've projected a 5-year hold.
Awesome. Well, Michael, as we wrap up, I have 2 additional questions for you. First, what did you find easy during this process that, quite frankly, you thought would be more difficult? And then let's flip that question on its head. What ended up being harder that you thought actually would be easier?
Good questions. What I thought was going to be harder was winning the deal. When I heard about all the competition and the final 3, I had kind of resolved and in my own mind that, if we don't get the deal, we'll find something else. Having that little pep talk with myself, there'll be something else, don't worry. And when we found out we were awarded the deal, it was a great moment and figured, boy, it was easier than I thought. Even though we had to fight hard to get it and put our best foot forward. What was more difficult? I guess what was more difficult than I figured was figuring out the various floor plans and rents in the building because there's so many. Even though it's mostly studios and 1-bedrooms and a smattering of 2-bedrooms, but studios and 1s are designed for the demographic that this particular neighborhood serves. There's probably 8 or 9 different floor plans within the studios and 1-bedrooms. So it's kind of hard to learn those and figure those out. Many of them, fortunately, have balconies and terraces, which make them really attractive. So it took us a while to get on, really just kind of figure out the building and the layout. We handled it, but it was a little more challenging than a typical cookie cutter building.
That's a lot of variety in a building.
Yeah, it's
I've quite
amazing.
seen that.
Yeah, me either.
Well, Michael, thank you so much for spending your time with us here today and sharing your insights. If listeners want to find out more about you, how can they do so?
Our company is MZ Capital Partners. They can find us at www.mzcapitalpartners.com, or they're welcome to email me anytime directly at mhz@mzcapitalpartners.com.
Awesome. Michael, again, thank you for sharing your knowledge and expertise with us here today. We look forward to hearing about your future deals.
Thank you. Pleasure.